group, YEY and Yearners, will present about financial reporting for SMEs.
The Malaysian Accounting Standard Board (MASB) issued the Malaysian Private Entities Reporting Standard (MPERS) in February 2014. The MPERS apply to private entities only. A private entity apply the MPERS for annual periods beginning on or after 1st January 2016. Today, our team is going to explain what is MPERS, private entity and non-private entities, IFRS for SMEs versus MPERS, the differences between MFRS and MPERS. Before we talk further about MPERS, let's go to the basis, which is the definition of the private entity. A private entity is a private company as defined in Section 2 under a Company Act 2016. That is not itself required to prepare or lodge any financial statement under any law administered by the Security Commission or Bank Negara Malaysia, and it is not a subsidiary or associate or jointly controlled by an entity which is required to prepare or lodge any financial statement under any law governed by Securities Commission and Bank Negara Malaysia. The MASB introduced two-tier financial reporting framework in 2006, intending to reduce the financial reporting compliance burden of private entities. In 2006, because of increasing complexities in MFRS, the board announced its decision to change the final reporting framework from a single tier to a two-tier financial reporting framework to reduce the financial reporting burden of smaller entity. As a result, private entity were given the option to apply either MFRS or the MPERS. After the board's announcement, private entities have two options to comply their financial statement. Which is they can choose either MFRS or MPERS, while the non-private entities still using the MFRS. Next, I will explain the type of entities that must comply with Malaysian standard. Basically, in Malaysia, we have three types of entities that must comply with Malaysian standard. The first one is non-private entities. Non-private entities will comply with MFRS. The second one is the private entities. Private entity has an option either to choose MFRS or MPERS. These two entities will governed by MASB. And the third one is the public sector, which must comply the MPSAS. The public sector will govern by Jabatan Akuntan Negara Malaysia, JANAM. Next, I will explain part 2, which is private entity and non-private entity. How do we know it is either private entity or non-private entity? I'm going to give you a few examples. Firstly, I will choose Malayan Banking Berhad, which is known as Maybank. Maybank is 100% non-PE. Why is that? Let us recall the definition of private entity, shall we? Private entities is a private company as defined in Section 2 under Companies Act 2016. Malayan Banking Berhad, Maybank, is a financial institution that is bound by law to prepare and lodge financial statements under Bank Negara Malaysia and Securities Commission. In other words, final institution will use MFRS. So, they will prepare their financial statement using MFRS. Another example is Samdabi Berhad. We all know Samdabi Berhad, don't we? But do you know whether this company is private entity or non-private entity? Again, let us recall the private entity definition, section 2, 2B, Company Act. It is clearly stated that Gas Malaysia Synergy Drive Sdn Bhd is joint venture to the holding company. All of them will follow their holding company by preparing their financial statement using MFRS 2. The last example is Ramli Food Processing Sdn Bhd. Ramli Food Processing Sdn Bhd is private entity because of the Sdn Bhd. So, its subsidiaries, Ramli Project Management Sdn Bhd, Ramli Halal Kiosk Sdn Bhd, and Ramli Halal Logistics Sdn Bhd will follow its parent as private entity. They can choose either to comply MFRS or MPERS. Next, I will explain who should choose MPERS and who else should choose MFRS. As we know, private entity can choose to apply MPERS or MFRS. But what are the criteria to choose either one? If the company does not have public accountability, which means they have no debt or equity that trades in public market, which means they have no debts or equities that traded in public market, such as Bursa Malaysia, and they are not in the processing to issuing instruments for trading in the public market, which is initial public offering IPO. Then the private entity will choose MPERS and vice versa. In additional mathematics, chapter 1, we learn about relationship, am I right? One to one, one to many, and many to many, and so on. Here, we should apply that knowledge. Do recall. First one, MFRS consists of several sections of MPERS. For example, MFRS 101 consists of section 3, 4, 5, 6, 7, and 8. The second relationship is that one section MPERS consists of two MFRS, which is section 7 consisting of MFRS 101 and MFRS 107. The last relationship is none to many. There are some MFRS that does not exist or irrelevant to MPERS. For example, MFRS 4, 5, 8, and so on. Now, I am going to explain the differences between MPERS and MFRS from section 1 to section 7. As we can see in this table, there is no significant difference from section 1 to section 6. Next, there is a low significant difference between section 7 and MFRS 107 and MFRS 101. In section 7, no explicit requirement to disclose the effects of acquisition and disposal of business unit. As we can see, they just prepare the financial statement, just few information and just simple. Compared to the entities that using MFRS, they must give the detail in every cash flow. The entities requires presentation of cash flow statements that reflects the inflows and outflows of cash and cash equivalent from operating, investing, and financing activities, and reconciling the movement in cash and cash equivalent. As we can see in the financial statement, they need to list down all the details about the cash flow statement, the inflow and outflow cash and cash equivalent.
Thank you, Iwan, for the explanation. Hi everyone, my name is Norfai Mazatul Nazira. We'll explain the next differences in MPERS and MFRS, which is in section 8 until section 14. So let's take a look at the table. For section 8 is Note to Financial Statement, MFRS 101. There is no significant difference because it's present about the financial statement and accounting policies. Next is section 9, which is Consolidated Financial Statement, and separate financial statement, MFRS 10 and MFRS 1 to 7. And I will explain it in detail for the next slide. For section 10 is accounting policies, estimate and error, MFRS 108. There is no significant differences except the simplified disclosure in MPERS. For section 11, which is basic financial instrument, and section 12, other financial instrument issue, have a same MFRS, which is MFRS 9. The next is section 13, which is inventory, MFRS 102. There's no significant difference except MPERS allow the cost of inventory to be measured at most recent purchase price. And the last section that I will present is section 14, which is investment in associate, MFRS 128. There's no significant difference except the following appendix that I will explain later. So now I will state the difference of each section except for section 8 and section 12. Section 9, which is consolidated financial statement and separate financial statement. In section 9, accounting for consolidated financial statement and separate financial statement is dealt with the same standard, while in MFRS it was divided by two, which is in MFRS 10 is for consolidated financial statement, and for MFRS 1 to 7 is for separate financial statement. The second difference is requirement to present the consolidated financial statement. In section 9, it allows a scope exclusion. When the parent itself a subsidiary, ultimate parent produce the consolidated financial statement that comply with the MPERS and MFRS. So the parent must need not to present the consolidated financial statement. While in MFRS 10 and MFRS 1 to 7, it has a similar scope per item, but it has more conditions to satisfy. For example, instruments are not traded in the public market. They did not file the financial statement with the regulation, so the parent must present the consolidated financial statement. For section 10, which is accounting policies, estimate and error, MFRS 108, the difference between section 10 and MFRS 108 is, in section 10, it does not require to disclosure the standard that have been issued, while in the MFRS 108, it required to disclosure the standard that have been issued. This is comply with the MFRS 108 in the box. Next is section 11, which is basic financial instrument. The difference between section 11 and MFRS 9 is that in section 11, it requiring to use the transaction price to measure the initial recognition, while in MFRS, it required to use the fair value to measure the initial recognition. The second difference is, in section 11, it does not provide a categorization in financial asset, but it has three measurement bases that have been specific to use. First is amortized cost, second is cost less impairment, third is FVTPL, which is fair value through profit and loss. While MFRS it provides for categories in financial asset and each measure using a different basis. So now I will explain the three measurement bases in MPERS. First is amortized cost is used when to measure the debt instrument. And the second is cost less impairment is used when to measure the commitment to receive the loan. And the third is fair value through profit and loss is used when to measure the investment in non-convertible present and putable ordinary. So here is the example from Remco Systems Sdn Bhd. It stated in the financial instrument notes that a financial instrument is recognized by using a transaction price, and it complies with the MPERS in section 11.3. And next is the financial instrument category in financial asset and financial liability. In Remco systems in neighborhood, they only use amortized costs, as you can see in the box, in the red box. Next is inventory. The difference between Section 13 and MFRS 102 is, in Section 13, it allows the cost of inventory to be measured with most recent purchase price. There are three techniques that can be used to measure the cost of inventory. First is standard cost. Second is retail method, and third is most recent purchase price, which is it referred as first in, first out. While in MFRS 102, measuring the cost of inventory based on MFRS 102 paragraph 21 is using a standard cost and retail method. As you guys can see, in Laporan Tahunan Majlis Agama Islam Wilayah Persekutuan, the cost of inventory measured by first in, first out, which is most recent purchase price. The last that I will present is about Section 14, which is investment in associate. The difference between Section 14 and MFRS 128 is, in Section 14, there are three choices that can be used. First is cost of method, equity method, and the third is fair value method. While in MFRS, it's stated that it must be accounted under the equity method. So, based on laporan tahunan Majlis Agama Islam Selangor, they stated that they use an equity method. So, for the next section, I will pass to the next presenter, Husna.
Thank you, Nazira. Hi everyone, I'm Husna Nadira. I will continue to present the differences between MPERS and MFRS for Section 15 until Section 21. Before we go further to the details, let's take a look on the table beside me. There are 6 sections in MPERS, which are Sections 15 until Section 20, that have no significant difference except Appendix D until Appendix I when compared to MFRS. There are investment in joint venture, investment property, property, plant and equipment, intangible asset other than goodwill, business combination and goodwill, and leases. But don't worry guys, all of the appendix I will explain further in the next slide. But not to forget, for Section 21, provision and contingencies that compare with MFRS 137, there is no significant difference. The recognition criteria of a provision are the same as those of MPERS and MFRS that uses a past obligating event, probable outflows, and measurement ability for recognition of a provision. Now, we can proceed to the next slide. Now, we will see the differences for property, plant, equipment between MPERS Section 17 and MFRS 116. Under MPERS Section 17, the useful life and residual value will be reviewed only when there is a significant indication. But for MFRS 116, the useful life and residual value will be reviewed at each financial year end. Now, let's take a look to the notes to the financial statement from MAWIP. In the red box, state that they will review the useful life and residual value of PPE when such indicators are present. It is comply with MPERS Section 17.90. Now, we will see the differences between MPERS Section 15 and MFRS 128 for investment in joint ventures. For MPERS Section 15, entities should account using one of the following methods: the cost method, equity method, or fair value method. For MFRS, entities should follow the MFRS 11 for joint arrangement. Is it the joint operation or joint venture? If it is joint venture, it will follow the MFRS 128, and the entity should account the investment in joint venture under equity method. Now, we will see the differences between MPERS and MFRS for business combination and goodwill. We will compare MPERS Section 19 with MFRS 3. Under MPERS Section 90, it requires acquisition cost to be capitalized as a part of the cost of the business combination, while for MFRS 3, it requires acquisition cost to be expensed when incurred. Other than that, under MPERS Section 19, it requires non-controlling interest to be measured based on its proportionate share of fair value of the net identifiable asset, while under MFRS 3, it requires non-controlling interest to be measured either based on its own fair value at the date acquisition or based on its proportionate share of the fair value of non-identifiable asset of the subsidiary at the date of acquisition. Furthermore, under MPERS Section 19, it requires goodwill to be capitalized and amortized annually and also subjected to the impairment test when there is an indication, while for MFRS 3, it requires goodwill to be capitalized and not amortized, but it will subjected to annual impairment tests. Now, we can see the notes to the financial statements for business combinations from Financial Statements Wonderful SME. It states that the non-controlling interest is the acquirer is measured at the proportionate share of the acquirer's identifiable net assets at the acquisition date, so it complies with Section 19. Now, for the notes to the financial statement for goodwill, in the red box, state that goodwill arises on business combinations and is initially measured at its cost. After initial recognition, the group measures the goodwill acquired in a business combination at cost less accumulated amortization and accumulated impairment losses. It is compliant with MPERS Section 19.23. Now, we will see the differences between MPERS and MFRS for leases. For leases, we will compare MPERS Section 20 with MFRS 16. As for your information, for leases, MFRS 117 had superseded by MFRS 16 for period beginning on or after 1st January 2019. So, we will use MFRS 16 for leases. For MPERS Section 20, we will use risk and rewards approach for classification of leases. It will define as finance lease if it transfer substantially all the risks and rewards incidental to ownership, and it will define as operating leases when all other leases not meet transfer of risk and reward criterion. For leasing accounting under MFRS 16, it applies a right of use approach which requires a lessee to recognize assets and liabilities for the right and obligations in lease contract. At the commencement date of lease, the lessee obtains a right to use an underlying asset of a period of time, and the lessee makes the underlying asset available for use by the lessee. With this approach, there is no longer difference between finance leases and operating leases for lessee accounting. While for lessor accounting under MFRS 16, it retains risk and rewards approach of the current standard, that is MFRS 117, and is also no significant changes when compared to MFRS 117. Other than that, for MPERS Section 20, it has no specific guidance on the classification of leases of land and buildings, while for MFRS 16, the scope is wide and more detailed clarification on the classification of lease of land and building. Now, as you can see from the slide, this is notes to the financial statements from Wonderful SME for leases. There are two boxes. It comply with Section 20 in define their operating and finance leases. So guys, that's it for my part. So I will pass to the next presenter, Nurul Amira. But wait guys, are you still listening to me? I hope all of you still pay attention to me, okay? Now, we will see the differences for investment property between MPERS and MFRS. We will compare MPERS Section 16 with MFRS 140. Under MPERS Section 16, investment property that fair value can be measured reliably without undue cost or effort shall be measured at fair value through profit or loss. And all other investment property is accounted for as PPE by using the depreciated cost method. While under MFRS 140, the entity will choose its accounting policy, either fair value method or cost method. Now, as we can see from the slide, this is the statement of financial position by MAWIP as 31st December 2018. As we can see, MAWIP stated that the investment property at fair value and cost is comply with MPERS Section 16. Now, as you can see from the slide, this is MAWIP accounting policies for investment property. And MAWIP state that investment property whose fair value can be measured reliably without undue cost or effort shall be measured at fair value at each reporting date with changes in fair value recognized in profit or loss. Other than that, MAWIP also state in their accounting policies for investment property that they should account for all other investment property using cost method in section 17. Now, let's move on to the differences between MPERS and MFRS for intangible assets other than goodwill. For MPERS Sections 18, it requires all intangible assets to be amortized over the useful life based on the management best estimate, but shall not exceed 10 years. While for MFRS 138, it has infinite life and indefinite useful life. For finite useful life, it has amortization and will be tested for impairment with indicator. But for indefinite useful life, it has no amortization and will be tested for impairment annually. Under MPERS Section 18, it requires all research and development expenditure to be recognized as expense when incurred. But under MFRS 138, for the research expenditure and the research phase will be recognized as expense when incurred. But under development phase, for development expenditure, it will be recognized as expense when incurred. The development expenditure also can be capitalized with certain criteria.
Thank you, Usna. Now it's my turn. Hello everyone, my name is Amira and I'm going to present the next section, which is section 22 until 28. Before I go through one by one section, here show you the cover differences between MPERS and FRS. As you can see from this table, have two section and two FRS has no significant differences between standard MPERS and standard FRS. For the first section that not has significant differences is section 22. Okay, next take a look at section 26. Share-based payment has no significant differences between FRS 2. So this scope is the same with FRS 2 and it covers three types of share-based payment, which is equity settle, cash settle and transaction choice of settlement. Either want to choose cash or issue equity in instrument. For this standard recognized when the good or service are received and generally are recognized as expenses in the profits or loss. So let's move on to the next slide. I will explain in details for the rest of the differences between MPERS and FRS. So here, section 23 and FRS 15 refer to recognition of revenue. There have significant differences between these two standards. So the first differences between these two standards is objective and scope, where for this section 23 should be applied accounting for revenue arising from the following transaction and event: sales of goods, the rendering of services, construction and contracts, and the use by other of entities asset, which is interest, royalties or dividends. While for MRF 15, the objective of this standard is to establish the principle that entities should apply to report useful information to user financial statement about nature, amount, timing, and quantitative revenue and cash flow arising for a contract with customer. Entities should apply in this standard to all contract with customer except lease contract refer to MRF 16, insurance contract FRS 4, financial instrument and other contractual right or obligation refer to MFRS 9, and non-monetary exchange between entities. Okay, next differences is for recognition section 23. An entity should measure revenue at the fair value, consideration received or receivable. In this section, usually entities apply the revenue recognition separately to each transaction. Entity need to identify separately identifiable components in a multiple element transaction, and also need to combine multiple transactions if they are closely interlinked. It's simple for revenue recognized when the entity should recognize revenue to depict the transfer of promised goods or services to customers, in which the entity and amount that reflect the consideration expect to be entitled in exchange for those goods or services. Revenue arising for the contract with customer accounted for using 5-step model. We have 3 type recognition here. For the first recognition is sales of goods. An entity should recognize revenue for the sales of goods when all the conditions are satisfied. The entity can use a risk and reward approach for the recognition of sales of goods. Next, for the rendering service, when outcome can estimate in reliable, revenue is recognized using the percentage of competition method. While when outcomes cannot be estimated reliable, revenue is recognized only to the extent of the recoverable expenses. And the last one, entity should recognize revenue arising from use by others of entities' assets on the following base: interest income, royalty, and dividends. Okay, last differences of revenue between MPERS Section 23 and FRS 15. For Section 23, in general disclosure, the accounting policy adopted for recognize of revenue amount of each category of revenue and revenue arising from exchange of goods or service. But for revenue from construction contract, entity should present amount due from customer as assets and amount due to customer as liability. For MRF 15, qualitative and quantitative information about each contract with customers, the significant judgment and charge in the judgment, and any asset recognized from the cost to obtain or fulfill a contract with customer. Now, let's take a look at Accounting Policy Annual Report from Majlis Agama Islam Wilayah Persekutuan Mai. Regarding to MPERS Section 23.26 Subsection C, entity should recognize revenue on dividend when the shareholders' right to receive payment is established, and refer to MPERS Section 23.10 Subsection A. Entity should recognize revenue from sales of goods when the entity has transferred to the buyer the significant risk and reward of ownership of goods. Government grants. What is the government grants? Government grants is assistance by government in the form of a transfer of resources to an entity for past or future compliance with certain conditions relating to the opening activities of the entity. For recognized Section 24, if they have specified condition imposed, the grant is recognized in income only when the performance conditions are met. But when there is no specified future condition imposed, the grant is recognized in income when the grant proceeds are receivable. However, grant received before the revenue recognized criteria are certified, grants are recognized as a liability. Otherwise, for recognized MRS 120, There must be reasonable assurance that the entity will comply the condition attached them and the grant will be received. Government grants should be recognized in profits or loss on a systematic basis over the period in which the entity recognized as expenses. Then, for the measurement government grant should be measured at the fair value of the asset received and receivable. No exemption or provide for non-monetary government and no requirement to treat the benefit of government loan as a grant. But for MRS 120, non-monetary government grants may be measured at the fair value of assets received based on the nominal amount paid, and loan is measured at the present value of the future payment and accounted for as a financial liability. Therefore, the difference between nominal value and the present value is treated as a government grant. So, here the example practice from annual report from MYEY in accounting policy, where they require that all government grants to be measured at the fair value of the assets received or receivable refer to MPERS. So, let's us continue for the next section 25 versus FRS 123 for borrowing costs. Borrowing costs are interest and other costs that an entity incur in connection with the borrowing of funds. From these two standards have a significant difference. For MPERS section 25, recognize all borrowing costs as expenses in the profit or loss in the period they are incurred, and no option of capitalized borrowing costs and qualifying assets alone. However, for MRS 123, borrowing costs that are directly related to a qualifying asset should be capitalized as a part of the cost of the asset, and all the other borrowing costs to be recognized as expenses. So, the borrowing cost in annual report MYEY regarding MPERS section 25.2 said, an entity should recognize all the borrowing costs as expenses in profits or loss in the period in which they are incurred. And in the income statement MYEY, that borrowing cost, which is finance cost as expenses in the profit or loss in the period, refer to that MPERS section 25.2. For impairment of asset, we will refer in MPERS section 27. Meanwhile, for the standard FRS, we will refer to FRS 136. As we know, asset impaired when carry amount exceed the recoverable amount. These two standards no significant differences except requirement in indicator and disclosure. For indicator section 27, there is assets subject to the impairment test only when there is an indication of impairment. And disclosure for section 27 is more simplified than disclosure for FRS 136. When impairment losses is recognized, immediately recognized in a profit and loss, and no provision in treat impairment loss as a revolution decrease. But for FRS 136, indicator refer to indefinite useful life and infinite useful life. For indefinite useful life, impairment tests must be performed annually, while for infinite useful life, impairment tests only when there is an indication of impairment. For disclosure FRS 136, for assets carry on the cost model recognized in our profits and loss, and for the carry of for the assets is carry at revolution model, any impairment loss as treated as a revolution decrease. And last one from me is employee benefit, refer to MPERS section 28 and FRS 119. Employee benefits are all forms of consideration given by an entity and exchange for service rendered by employee. And for these two standards have a little bit differences, where For MPERS Section 28, allow to the entity recognize actuary gains or loss in the profits or loss, and also can recognize in other comparison income. And for the accounting rules is more simplified for defined benefit plan or post-employment benefit, which is calculated based on the present value of its defined benefit obligation minus the fair value. Now, I will pass the presentation to Atira.
Thank you, Amiga. Next, we will discuss on Section 29 to Section 35. Section 29 of MPERS is income tax. Its equivalent MFRS is MFRS 112. Section 30 is about foreign currency translation. Its equivalent MFRS is MFRS 121. The next one is Section 31, hyperinflation. Its equivalent MFRS is MFRS 129. Section 32, events after the end of reporting period, equivalent with MFRS 110. The next one is Section 33, related party disclosures, equivalent with MFRS 124. Next is Section 34, specialized activities, equivalent with MFRS 6 and also MFRS 141. The last one is Section 35 of MPERS, equivalent with MFRS 1. In the next slide, I will discuss those sections which has significant differences with its equivalent MFRS. Section 29 of MPERS is about income tax. Its equivalent with MFRS 112. In Section 29 income tax, it requires the offsetting of tax assets and liabilities when the conditions are met, but permits undue cost or effort exemptions, while MFRS 112 requires the offsetting of tax assets and liabilities without any undue cost or effort exemptions. MPERS Section 29.4 requires an explanation of any significant differences between the tax expense and accounting profit multiplied by the applicable tax rate. However, the exact form is not prescribed, which means the entity can choose whatever form they want to use. Shown here is a reconciliation of income tax expense taken from the STF Group's 2018 financial statement. STF Group used numerical form to explain the differences. Meanwhile, in MFRS 112.81, it clearly stated that the form numerical reconciliation is required to explain the differences between the tax expense and the applicable statutory tax amount. Included in the slide is the numerical reconciliation for Malaysian Genomic Resource Centre in its 2019 financial statement. Section 30 of MPERS, which is foreign currency translation, is equivalent to MFRS 121. In MPERS, on disposal of a foreign operation, the gain or profit is the difference between the proceeds and its carrying amount at the date of disposal minus the cumulative exchange reserve. In other words, there will be no recycling of cumulative exchange reserves. Meanwhile, in MFRS 121, on disposal of a foreign operation, the entire cumulative exchange reserve, excluding the NCI's portion, will be cycled to profit or loss. MPERS 30.25a has stated that an entity shall disclose the amount of exchange differences recognized in profit or loss during the period. In the example shown, the highlighted part is net foreign exchange losses presented under the profit before tax. MPERS 30.25b also stated that an entity shall disclose the amount of exchange differences arising during the period and classified in a separate component of equity at the end of the period. In the example shown, The translation differences of foreign operations is put in statement of comprehensive income under other comprehensive income. The next section is section 33 of MPERS. It is about related party disclosures. Its equivalent MFRS is MFRS 1 to 4 by the same name. The significant differences detected between these two standards are the key management personnel composition and also the disclosure of transaction and balances. In section 33.7 of MPERS, key management personnel composition shall be disclosed in total as shown in the excerpt from MAWIP's Financial Statement 2018. The total amount paid to MAWIP's key personnel management is stated at 806,148 ringgit for the whole group and 480,000 ringgit for MAWIP only. Meanwhile, in MFRS 124.17, the key management personnel composition shall be disclosed in total and also by categories. The categories are as follows. A is short-term employee benefits, B, post-employment benefits, C, other long-term benefits, D, termination benefits, and E, share-based payment. In the example taken from Malaysian Genomic Resources Centre 2019 financial statement, the first category, which is the short-term employee benefit, is clearly shown at 1,470,182 ringgit and 1,184,104 ringgit for the group and the company respectively. For the disclosure of transaction and balances, MPERS 33.10 requires the disclosure to be done in 4 categories of relationship. The first one is entities with control, joint control or significant influence over the entity. Second one is entities over which the entity has control, joint control or significant influence. Third one is key management personnel of the entity or its parent. And the fourth one is other related parties. In the example shown from STF Group Financial Statement 2018, Asian Banking School Sdn Bhd and also Asian Institute of Chartered Banking are the related parties to STF Group. The next example from MAWIP Financial Statement 2018, the example shown is about key management personnel of the company and its parent. Meanwhile, in MFRS 124.19, the disclosure of transaction and balances shall be done in 7 categories of relationship. The first one is the parent. Second one is entities with joint control or significant influence over the entity. The third one is subsidiaries. The fourth one is associates. The fifth one is joint venture in which the entity is a joint venture. The sixth one is key management personnel of the entity or its parent. And the last one is other related parties. The last section of MPERS would be section 35, which is transition to the MPERS. Its equivalent MFRS is MFRS 1. The requirements for first-time adoption of MPERS are essentially the same as MFRS. However, MFRS 1 requires an entity's first MFRS financial statement must have pre-statement of financial positions, including one as at the date of the transition. In section 35.4, there is a guide to decide who is the first-time adopter of MPERS. It was explained that the financial statements prepared in accordance with the standard are an entity's first such statements. If the entity did not present financial statements for previous periods or presented its most recent previous financial statements under nation requirements that is not consistent with the standard, or presented its most recent previous financial statements in conformity with other standards such as PERS, MFIS, and also IFIS. For an entity to transition to the MPERS, they should follow these steps. First, identify the date of the transition. Second, prepare the opening statements of financial position. And third, provide the disclosures to us. We are now at the end of our presentation. To sum it up, for a company to decide which standard to use for their financial statements, they should be asking this question. Is their company incorporated under Companies Act 2016? If no, then they should apply accounting framework as required by relevant laws and regulations. If yes, then they should decide whether their company is a private company as defined under Section 2 of Companies Act 2016. If no, then they should apply MFIS. If yes, then the next question follows. Is the entity itself or jointly or associated? If yes, then they should apply MFIS. If no, then is the entity itself or jointly or associated? If yes, then they should apply MFIS. If the answer is also no, then they are free to choose whether to use MFIS or